So, today we have to talk about short-term funding. So, in the lecture notes, so this is the ugly duckling of the semester because financially it is so interesting that this is an alternate funding source, or bonds are interesting because we can earn money with them. Short-term funding is practically just a survival guide to operate a company, so it's much more like a mixture of accounting and finance. And this is absolutely essential for day-to-day operations. Just uh, just to teach, it's much more like talking about bullet points. So this is not much art, just listing stuff again and again. So at least what I at least enjoy is to talk about payment methods. So how can we collect money from our clients? Because this behavior, how can we structure and define payments, is completely dependent on the asymmetry between us and our clients and also our vendors. So in this case, that actually this is my wife's job. So she is always telling me that she is working and strange mixture of accounting and finance, and yeah, so because she serves different airports or supervises different airports and buildings at RBP, and at the family dinner time, I always listen to these stories that so there are some vendors who are only operating at prepayment. So it's really strange that we have the same company, sometimes at the same location, but for some reasons, uh, uh, some players are only allowed to be supported by prepayment methods, so they are just paying. They have some idea, obviously, that how much fuel do they need during the months, and after that they are just paying advance at the beginning of the month, and after that they are just using this one up. Obviously, billing procedure happens in the background, so at least the fulfilling of the contracted fuel, and after that they are closing down at the end of the month. So in this case, obviously you would like to minimize the risk exposure. So if you assume that at the level of partner risk, we don't want to take any kind of a partner risk. So in this case, if you are powerful enough, then you can say that for the local client that okay, we are not only doing prepayment for you, because in this case what happens that also the client, due to or through prepayment, practically provides you a free loan for until it's not delivered. And in this case we have similar, not completely the same, but similar stuff with the consignment, where shipment is done. Usually, this is much more like in the manufacturing sector, that, or for example in healthcare, that when you need a huge and diverse warehouse for products on site, but you don't want to buy all these products because you just have to pick up some of them, but still to maintain robustness in your service, you have to keep this supply close to your operations. So consignment is usually that okay, they are delivering, they are filling up the warehouse, but until you are not taking out any item, this is owned by the vendor. And once you are starting to utilize this different products, then you have to pay. So so that's why this is a specialized on-site warehousing or supplying contract, which is also flexible. It provides flexibility, but again, until you are not using it, you are just using up short-term financing from the vendor. So that one is also interesting. If you have letter of credit or practically slide draft or trine draft, they are quite similar. Just in case of letter of credit, we have also an intermediary. So first we have to deliver. Then once we have the paper about the delivery, then the bank, or sometimes it's even not a bank-like entity, but some kind of an intermediary will step in, pay the bills, and after that they are just maybe accumulating an invoice, and after a month or after a defined time period, then this payment will be done by the company. Again, this provides much more flexibility. Maybe you can also outsource some of your accounting. Hi. So maybe you are outsourcing also some of your short-term funding. But this can be also a sign of liquidity issues. So, so letter of credit. In practice, this is also happening at this university, unfortunately. So whenever we have to go for conferences, obviously pro forma invoicing is coming from the event organizers, conference organizers, that we have to pay it. In the good old days, this was billed towards the university paid it, and then we were able to go on our merry ways. Nowadays, no, they are running a public procurement process, then one travel agency will be selected, you have to request another pro forma invoice for the name of this winning travel agency, then they are paying the invoice, and after that they are waiting until they are paid by university. So in this case you can free up liquidity, but obviously this will result higher expenditures. So obviously there is a trade-off that, okay, what you can save in the case of liquidity, then it will be some premium on the services will be collected by the vendor. So, oops. And of course, the worst case scenario is open account, when you are doing the shipment, and especially that was the case before 2008, when suppliers for any store chains like Tesco or whatever, they were just delivering and then hoping that not just after 1 month, after 3 months later, maybe they will start to get paid. And after that, regulations everywhere on the European continent, but especially in Hungary, they became much more stricter. So nowadays, hopefully you are not able to, or at least players on the market are not able to do this anymore, that they are just collecting goods from farmers, from other suppliers, and maybe you will get some payment 4 months, 3 months, 5 months later. Alexandra did this, but they defaulted terribly at first in the early half of the 2010s, and then later on completely in the second half of the 2010s. They were a bookstore, and they were just practically collecting books on their bookshelves, which were coming from the publishing houses. So they were literally trying to combine the consignment model with open accounts. That's the terrible case, because all the books were owned by the publishing houses, but sometimes they were not paid even after Christmas. So the last row was, it was still before COVID, around 2000, I think it was 2016, that finally, two publishing houses collapsed because they were not paid, and after that, the remaining or the rest of the publishing market started to ask for a closure, for a start of a bankruptcy procedure against Alexandra. So immediately they had to close down all the stores, and after that, Libri and other bookstores were taking over locations and everything. So open account looks nice until there is no friction in case of demand, until demand is stable, growing, then you can do it, but it can backfire immediately if anything happens with the size of the demand. So yeah. Then what people prefers to deal with is also inventory management. The Madura book writes so much about this, and they are so enthusiastic. Just okay. What is relevant, at least for us, in case of inventory management, is how it affects our working capital. And from financial point of view, so if you are not talking about accounting, in this case, what is highly relevant is this working capital financing policies. Again, this is how companies can finance themselves cheaply until they are defaulting. Because in case of moderate financing, this is what we should do according to textbooks, that if we have short-term assets, then it should be funded through short-term liabilities. If we have long-term assets, then it should be funded through long-term liabilities as well. But obviously, people are trying to tweak this one. So under aggressive working capital policies, they are utilizing less long-term liabilities, less long-term funds, and much more like they are relying on supplier credit. So they are just not paying in time, or they are trying to elongate the payment process. And again, until you are keeping your liquidity, until your demand is stable or growing at least, then it can work nicely. But usually companies are failing if they are not able to maintain this anymore. Right now, my favorite bicycle manufacturer has this, but also KTM, which is another motorbike and bicycle manufacturer, or they had also the chainsaw company, the Husqvarna, but now they had to sell it away. They try to do the same thing, that KTM was growing aggressively. So after there was this big manager who reorganized the whole company during the 90s. So they opened up huge set of product lines for motorcycles, and also for bicycles, and also for the e-bikes. And also they started to do many acquisitions. So they were not just growing horizontally, but also they tried to grow vertically. And what happened here, and also in many German companies, that they were able to do this until interest rates were really low. But since we don't have low interest rates in the last 3 years, 4 years now, then they started to run out of liquidity. So what can you do in this case? They started to reduce the size of the debt, at least the long-term debt. But also in case of short-term debt, that was also the nail in the coffin, because if you are utilizing short-term debt-based funding, then this will create, or in this case, you will face with the high interest rates. At least if you are able to issue long-term debt, or if you are able to take up long-term loans, still the impact of this interest rate growth was not that visible, because usually the longer maturities of the yield curves were not increasing as fast as the shorter, because everybody was expecting that, okay, this is a 1 or 2 year inflation burst, but otherwise we don't have to be afraid. So it was priced as a temporary thing. But if you are relying on short-term funding with interest rates, then it became much more problems. So it affected absolutely their profit margin. And especially in the bicycle business, there was the huge boom in demand, uh, not just in Hungary, but practically everywhere in the European continent. So demand increased sometimes by third. And the result was that there was a huge fight between even retail stores and manufacturers for components. So for chains and all the stuff what we need for even for a bicycle, so which is absolutely a commodity product, and even in the premium segment as well. So there was a huge gap between supply and demand. And once production started to ramp up to meet with this demand after 1.5 years, then suddenly demand collapsed. So now they are in the other end of the business cycle, and as a result, for example, Gepida, who mostly sold bicycles abroad. So okay, Hungarian market was relevant for them because they are manufacturing in Hungary, but otherwise they were in the premium segment, so uh, so their price tag was quite high, but also the built-in components were also really good. So if you were buying one, then you did not needed any further tweaking to make this trekking cycle or trekking bicycle operational. But if we were checking their data, then we can see that they were in surplus until the last 3 years, and after that, this surplus suddenly disappeared. So practically at this year already they were running with negative equity, so they used up all their capital buffers, and this year, at the end of this year or the beginning of next year, they should be forced to increase their equity. But instead of doing this, they announced closure. So last week they sent out emails to all the retail stores that all the contracts are terminated. They don't want to, or they are ceasing their operations. So this is happening on small scale, but also we can find many articles about KTM, which has similar stuff. And again, the problem is that in this case they are manufacturing premium products with higher price tags, higher margins. So we're not talking about the low end of the market. So aggressive growth, relying on short-term funding in an environment with changing interest rates can be quite deadly, even if we are saying that, oh, in this case we are not locked into long-term debt. Sometimes it's much better if you are locked into long-term debt until that one is stable or the bank is not a jerk. So conservative funding, sometimes it's connected with organic growth. So many companies try to minimize their debt levels not because of financial necessity or not because of high interest rates, just this is their way of operations. So they are reinvesting the money which was already earned, or they are just utilizing stock market only. So they are selling shares and they like to minimize their debt levels. In this case, the problem is that you are sitting on a huge pile of cash, and which is not a problem, just somehow you have to convince also shareholders that they have to give this money, and until the whole company is operational and profitable, so your margins are nice enough, then nobody cares. But if we can see that operational profit is not much, and also they are using conservative funding, then usually the management will be fired at the next shareholders meeting. So, yeah. Then, this is what we have to test tomorrow. Operating cycle. So, average age of inventory, so selling finished good on account and purchasing purchasing raw material on account. In the case of our case study, that we have to buy sheet metal, we have to buy all these powders for the 3D printer machine, and of course some electricity to make our rocket. Or for example, some of you should buy also engines from external vendors for US dollars sometimes, and sell the finished product on account. So it means that usually in this specific sector, it's really easy to see when stuff is delivered because it's hard not to see it. And after that, you will be paid. So in this case, we can practically simulate what happens. So if in the first several years, if we are scheduling that, okay, we are low launch cadency, then this operating cycle will be stretched out because long term we need more time to manufacture the whole. So both the first stage, both the second stage, integrate them, test, and so on. So it takes time not just manufacturing but also testing before launching anything. We are not SpaceX. SpaceX was able to explode once a Facebook satellite that before launching, a day before they just running tests, they were fueling up stuff, and when during fueling, they started to fill up with liquid oxygen, one tank, and within this big tank there is a smaller tank for helium gas, because once you are starting to use up oxygen, then you have to put in an inert gas to maintain the pressure, especially in low gravity environment. And this small tank with the helium was made from carbon fiber composites. It's always made from carbon fiber composites. Unfortunately, if these stages are falling back and burning up, usually this carbon composite is so strong that it's not burning away. So sometimes it hits buildings or other structures. Luckily not people, at least not yet. So this is made for carbon fiber, and somehow some liquid oxygen went into this structure, and then it formed oxygen ice on the surface of the carbon and started to make a reaction, and suddenly everything was burning up. And went for explosions. So after that, they had to redesign the all of these carbon composite things. But in this case, obviously, they were not paid by Facebook. So that was a sad moment. So after that, NASA was also itchy to put astronauts on the top of rockets, because the problem was that at first you have to put the astronauts in, then they are filling up because within 10 minutes you have to go for lunch. Otherwise, all the liquid oxygen start to boil off. Also, the kerosene was fueled or loaded in at a really cold temperature, in this case also to increase density. So this is really nice, just literally they have to sit on a ticking bomb. So until the launch cadence is really low, practically we are increasing the operational cycle. So we have to provide a virtual loan for our clients until they are paying us. At least at this market nowadays, people are not launching one or two satellites anymore. There are contracts for constellations. So you have to launch 20, 40, 50, sometimes thousands of satellites in orbit, or even Department of Defense contracts are also made in bulk. So they are just defining that, okay, you won this contract, now you have a contract for launching 20 cargo, undisclosed cargo with some range of tonnage, but that's all. So at least you can plan with that one. But higher launch cadence means or requires faster manufacturing. Also, that's why we have to solve the first stage reusage and recollection, because in this case we don't have to manufacture it, so it's also a way to reduce operational cycles, because we don't have to wait until everything is manufactured and tested and so on. Just we have to clean it and test it, and then we can push it back. So it means that at SpaceX, according to available data, usually it takes 1 year until they're starting the manufacturing and until they are launching stuff. With first stage reusage, they were able to reuse it for 1 month. So after 1 month of launch, then the same first stage can go back to the launch pad, and we can say that this one is a significant reduction in operational cycle, especially if you are paid for it. Next thing, that one is highly crucial for companies, but really boring for me. So cash conversion cycle. So
The CCC.
yes, the CCC. So how cash inflows and outflows are made. So at least in the operational cycle, we can see that, okay, there is a time for manufacturing and delivery. And here is the same thing, just also with the billing issues. So this is much more like, again, like accounting. So this is borderline finance now. But this is highly relevant, because if the liquidity position is absolutely stretched out, then this can be a problem. This is actually the days per year of inventory turnover and so on. If we are calculating it, then we can see also, we can have expectations about the financial runway of the company. So how much money do we have until and to maintain our operations from client money. So this is really important. Just this is much more like an accounting thing. Yeah. Do you want to attest? No. Go away. Several weeks ago, I was thinking that why I did not install Adobe PDF Reader. Now I know. And also, yes, so we are always laughing on management or marketing people when they are always coming with this 4 Ps or 5 Ps for product, place, services, and so on. But we have also the 5 Cs of credit. So we have character for the credit, we have capacity for the credit. So are we able to repay the requested credit? We have capital, and we have collateral, and we have conditions. So if you would like to sometimes reply for the 5P or 4P in marketing, then we can say also that we have 5 Cs, but again, these are obvious stuff. So also minimizing cash holdings. Come on. So we are in 2015, and still people are talking about, so what is happening in the business sector? Sometimes I have no idea. So using logboxes to keep cash and collect cash. Where? Existing wire transfer. Come on, now everybody should do this. Okay, I know some people who are running small, even medium enterprises, and still they are absolutely cash oriented. And they have all the banking services at their locations of operation. They are not laundering money. They are not cheating taxes. And still they are absolutely cash oriented. So this can be also the attitude of the owners of the management. But the rest of the civilized world prefers wire transfers, because you don't want to deal with all the issues of cash management, to store it, to to move it around, to pay for all these safety services, to check the validity of the banknotes. So, oh my god. I even have a friend who operates it's a camping site, but also it's a pub. So it's a complex services, touristical services are provided there, and they are not able to understand that why people are still using cards for payments. And we are always telling them that, come on guys, you're in the middle of nowhere, there is maybe an ATM in the village, but if people have their credit card with them, then practically they can have infinite amount of funds. If you have cash with you, then this is still limited because you have to rebuffer your cash reserve. So it's. But at the end of the day, what is relevant for us, that we have to forecast cash inflows, outflows, and ending cash balances. So tomorrow we will try to do this at least, because the benefit of that, the case study, is that we have really limited number of cash flows, and that's why it's easy to simulate. Obviously, for complex business operations, this requires a whole full person. When I was learning vector autoregression, so when I was showing you the foreign exchange macro modeling, that training was made for people from ministries of finance and also people from central banks. So I was just, I know them, and I was allowed to participate in this central bank program. And even at the level of state, obviously we need some people at the treasury, we need some people at the Ministry of Finance to plan all these cash flows ahead. And there were some people from the French tax authority, and they were telling that, oh, we have a whole department for only VAT forecasting to understand that how the money will flow in this year and so on. And there was another guy from Romania, and he told us that, yeah, I know also we have the same department, just this whole department is only one person, me. So he was doing the same level of job with the same features, job description, and so on, just instead of a department, it was a one-person job to do the same stuff. And after that, yeah, it's a bit more stressful. Yeah, so obviously, if we have a credit period, so how long to pay, shorter periods reduces stuff. But usually this is not voluntary, unfortunately. So the books describes this really nicely, that, oh, we have this credit period until we are not paid. But again, we have to go back to this figure here that, yeah, this is asymmetry. And if we have this asymmetric behavior, yes? Okay, no problem. So this is absolutely about asymmetry. So even if we are not happy with the credit period and how long are we paid or not paid, if we are operating on an oligopolistic market, or there is only one single buyer for our services, then we have nothing to do. We have to maintain this credit period. We have to form the entire liability structure or capital structure of the company to operate under these circumstances. So, yeah, timing is nice, but it's really hard to manage because this will be determined by market forces. The degree of freedom is that you would like to operate on this market or not, but otherwise, nothing like that. Then we have cash discounts, lowering price. That's the disgusting part. So when they are saying that, okay, we can pay you earlier, but with a discount, and no, or sometimes yes, but that's the unethical part of doing businesses. Yeah, collection policy. This is absolutely up to business relations again. How tough is the collection? Oh, one of my former thesis worker was working at this field, so they were collecting really tough people. So his favorite terrorizing method was the automated email. That once the collection time started to arrive, then there was weekly once an email to remind gently. Then if they were not answering, that we will deliver, then it started to increase the frequency to daily email. Then if they were still not responding, it was even written in the email, so he was able to automatize all these things, because you can do automatized emails through Google Docs. And then the frequency started to go for hourly. I was surprised that he was not putting any spam lists. So, but he was able to force out responses this way, which is quite aggressive but efficient. Yeah. And also similar is for trade credit, but let's go forward, because still after that the book has another, yes, interesting feature for us, at least for me, is, oh, there's a third one, sorry. So the second interesting thing, also out of the operational cycle, is when we have multiple currency exposures. So how can we deal with this one? So if I have to pay in US dollar, if I have to pay in euros, which one should be preferred? Taking up short-term loans in US dollar and also in euro to cover both expenditures until I get paid, or right now this is a valid problem, because in US dollar interest rates, at least key central bank rates, so, and everything is way more expensive, so key central bank rate is 4% at least, and in the case of the Eurozone it's 2%, so there is a 2% gap. So US dollar funding is more expensive, so it's double. And the book suggests that, okay, we can minimize the expected cost of this 2% margin by taking up all the short-term debt in euros, so using cheap funding in euro or cheaper funding in euro, and then by running exchange rate risk, then we can start to pay in US dollar, and hopefully the foreign exchange risk will not increase during this short time period, which sounds really strange nowadays when the volatility on the foreign exchange market is so high that what is the viability of this? So if you are going to Stoku, so let's assume that we are just looking 1 year backwards. We are making the contract for funding ourselves at the beginning of last year's December, and yeah, is it more expensive? But US dollar was weakening, so it was depreciating. So practically, if we are taking up a loan in euros and then converting the necessary parts to US dollars, this can be even more lucrative. So I was not messing up. Okay, so if we are lucky, we can do it, but obviously we can cut out different scenarios, different years when For example, if you are just picking up the case here and then there is an adverse change because some news happens, or if we were opening the position up here and then this is what we have 2.5 months later. So still this can be problems, but that's another dilemma what we have to solve. That's why I'm sad that I was not using imported engines. Next year we should. I should do that because in this case I'm losing one situation to talk about. And next one is cash pooling, or the possibility of cash pooling. Because what happens if we are realizing revenues in the same currency, or multiple currencies, and in the same currency we have also expenditures. Just obviously the temporary breakdown is not the same, so sometimes we have a burst of revenue, sometimes we have small set of expenditures here and there, and also these revenues are realized by different entities. So not just the parent company, but different subsidiaries are realizing different currency revenues or facing different currency expenditures. Many multinational companies are trying to run cash pools in this case, so all the foreign exchange management is centralized within a treasury, and this treasury tries to supervise all of this. So they're not converting down any of their US dollar revenues to euros or Swiss franc revenues to euros. No, they are just herding foreign exchange, and also they are investing this foreign exchange. And once they need it for expenditures, then they are just delegated. Which obviously this one requires a huge professional, or at least some professional layer at the level of corporate treasury. So you need specialized people who know how to invest this, because this thing is only profitable until you can find reliable short-term investments. So one of my friends, who was also a previous student at this faculty and also my thesis worker, works on this field, and that one is quite similar to credit collection, just at a different level, because in this case you have to terrorize banks. Because some banks just prefer to collect. It's much more like a wholesale deposit, so it's not several million forints or sometimes euros in the account, but a bit bigger, or more zeros, bigger scale, and still they don't want to pay any interest. So they are just sitting on the cash. Obviously, this is on the liability side, so on their asset side, from this cash-based liability, or they are purchasing government bonds or something short-term, or they are just lending out on the interbank market. And the job of the corporate treasury under these circumstances, and also many other circumstances, is just to terrorize the bank to understand that, okay, they can do it, but in this case you will close down this bank account, you are moving your deposit elsewhere. So suddenly, once they realize that they can lose a client, they start to pay also interest. So sometimes they can even force the banks to share some of the revenues which can come in from the interbank market. And if we are checking interbank market interest rates, so Ionia rate for the Eurozone. Oh, it was discontinued. Sorry. Now we have Easter. Top. what is the level of rate? So we can see that it's, even in euro, it's 1.9%. This is annualized interest rate, obviously, so you can get a really small set of this one. This is overnight interest rate, so each night you have to do this investment. But obviously, if you are talking about millions of euros, then this matters a lot compared to a liquidity account where you don't have any kind of an interest revenue. So at the beginning, one of the partner banks said that, oh, we don't have this service. Then they were asking that, okay, but are you doing overnight deposits? Yes, we are doing overnight deposits. So they were saying that, okay, each day they were asking the bank to do this overnight deposit. And after 2 weeks of terrorization, they realized that, okay, they were able to develop a product that they can do it in an automatic manner now. So they get macro with Excel sheet and so on, and suddenly they realize that now they have this service. So sometimes you have to force banks to cooperate, but in this case they were able to do it. Also, even within the Eurozone, it happens that banks or multinational companies are going outside of their local environment. So Slovenian National Bank, the head of the Slovenian National Bank, said this at one conference, that big Slovenian multinational companies are running their bank accounts, deposits in Italy or in Austria because of better conditions. Or also in Hungary, you don't want to keep money in euro deposits. Also, you don't want to keep it here. But not just for taxation reasons or for other reasons as well, because there are terrible taxes on revenues, on financial revenues. So not just interest-related tax, but also for private citizens there are additional wage-related taxes. So going back to the topic, you have to check also the liquidity surplus in the banking system. So for example, if you would like to invest or to save or to store euros in deposits at Hungarian banks, at least on the retail level, you don't get any interest rate. And not just at one bank, but we can check the banks, and usually the interest rate is 0 or 0.1 or something like this. And even if the interest rates were really high within the Eurozone, which is absolutely strange, because also at the same time in Austria, interest rates for deposits, even, term deposits, but still they were deposits, was at 4%, 3% in Austria with proper ish competition on the market. So, and in this case, we can see that some things are flowed, and in US dollar we have interest rates on term rates, or term deposits, even at retail level. So I'm not sure what is happening sometimes in the Hungarian banking system. And I'm talking about proper banks, so not MBH and other scamming companies. So, so intercompany loans can be absolutely crucial, not just on not just on long-term funding, because for long-term funding, it's obvious that if you are operating new subsidiaries, it's way cheaper to take up a loan as a parent company because you have proper collaterals, or even you just issuing shares. So, for example, the BID construction and the whole operation is funded through share issuance on the Chinese stock market, and then this money is coming here through the parent company, but also for short-term funding as well. In the banking system, short-term funding is way more crucial. So during the 2008 crisis, that was really interesting that people were afraid that, okay, most of the region's banking system is owned by banks from Austria, from Belgium, from Italy, and from Germany. And this can be a problem if these markets are failing, or at least liquidity dries up on the money market at these countries, because most of the subsidiaries in this region, but also the same thing happened in Estonia, Latvia, Lithuania, because 90% of overall assets were also owned by Swedish banks. So if liquidity dries up for the parent bank, then most of these banks had a really serious exposure towards their parent bank in terms of short-term funding. So they were running two cycles. One cycle was for the parent company towards their own domestic interbank market, and then there was a second cycle of liquidity between the parent company and the subsidiary banks. And of course, the banks were able to tap local interbank markets as well, but again, since liquidity was coming mostly from outside, that was not that deep, and also it was exposed towards excessive foreign liquidity. That was also the reason why Basel 3 or 4 requirements were implemented for liquidity. So now, if you have short-term positions, it should be funded through short-term liabilities. But if you have longer-term positions, then also you have to pair it with some longer-term liabilities. So you are not able to do this really aggressive funding anymore, because at some point before the crisis, none of the European banks were able to fund themselves only through client money. So loan-to-deposit ratios were everywhere above 100%, only in Czechia. And obviously in Czechia, the banking system was not affected by the 2008 crisis. They were just drinking beer during the whole ordeal. So they were just, the reason was that there was a really serious real estate bubble in 2001 or 2. And after that, they implemented really strict rules for bank operations, and after that, unintentionally, they were able to prepare for the 2008 crisis. So intercompany loans are really important. Local currency loans, they can be if there is liquidity surplus somehow. So if the local currency loan means that we are in Germany or we are in the US, then we can do it easily. But again, let's go back for banking. Before 2008, if you needed US dollar liquidity to provide US dollar loans for companies, then it was really simple. Your French bank went to the US money market fund. So money market fund in the United States, they're just selling this really short-term bonds, and then they are investing this money into the interbank market. So they are providing short-term loans for banks, or they are just purchasing short-term government bonds. And obviously, the 2008 crisis happened, so they were afraid of the interbank market, so they reallocated, they organized their portfolio to move much more towards government bonds, because that one is more safer. So some of the banks were just left outside in the cold without US dollar liquidity. So that was the reason that they had to run to their own central banks. So within the Eurozone, they were running towards the ECB. British banks went towards the Bank of England, or even Japanese bank had to go towards the Bank of Japan. And after that, they had to initiate these swap lines already in December of 2007, that US Fed provided US dollar short-term loans. So we are talking about overnight, 1 month, 3 months, something like this, loans to the ECB and other key central banks, and then they also provided US dollar liquidity from overnight until 1 month maturities for their own banking system, which is a really strange parallel infrastructure which was ad hoc at the beginning, just till several years later in 2015. Still, we have this to safeguard foreign currency lending. So that's why local currency market can work in foreign exchange as well, but maybe the depth will be different. Also, interest rates can be higher. That's why I don't understand what is happening with euro interest rates on the domestic market. Or euro markets. So euro markets, this is a really stupid name. They were coming up with this in the 70s, and so this euro market is not the euro currency. So not the euro currency, because euro bond markets means that we are issuing a bond, or in this case a bill, short-term bond, on a foreign capital market in a foreign currency. And this is called euro market, or euro bond market, or euro bill market, commercial paper. Yeah, because commercial papers are the short-term bonds for companies, and not bills, because that one is for the state. And we could do it. I know that Japanese companies are doing it, so they have a really deep commercial paper market, not just in Japanese yen, but also in other currencies. But I'm not sure about continental Europe. So mostly this job is done by banks, not through market entities. Beata Farkas had this really good paper published 3 years ago, when they were actually checking this one, and they were only able to say that in continental Europe, because UK is obviously market oriented, so that's a different kind of potato, but even in continental Europe, Spain is only market oriented, where companies are utilizing much more funding through bond market and short-term and long-term bond markets. And Denmark, maybe. Okay, I'm checking it because it's easier to look for my computer, because I was working with this one on the weekend. So who is market-based? Netherlands and Spain from my sample. And otherwise, oh yes, there is more. So Denmark, Netherlands, Spain, Sweden, and obviously UK. So in these markets also we can see that short-term debt can be also funded by companies on the bond market or through the bond markets. Also, there is the potential to collect foreign exchange liquidity, but otherwise, this should be the job of the banking system, not companies. So you have to be big enough to do this. But also, next week, when I'm talking about multinational companies' tax optimization practices, this topic will come back, because there are these specialized entities or financial vehicles, as usually the term is used for this one, so we have an Apple, or let's say Google. It's a US company, operates in US dollars, but they have the subsidiary in Ireland, which supervises everything what is happening in the European Union, and especially in the Eurozone. So they are nicely collecting funds in each currency. Do we pay for Google? Yes. Do they bill in US dollars, euros, or in Hungarian forints? I'm paying for them, for the YouTube Premium and also for the Google one. Anyway, so they are collecting, but I don't think so, that they are not billing in US dollars. Just and let's check it. Yeah, this is in Hungarian forint. So, yeah, this is not a hypothetical case anymore. So they are collecting their revenues in different currencies, and usually what happens that next week we were talking about it, but so there is one Irish subsidiary which does all the manual work. So they have proper people with IT support, accounting, and so on. But as a second layer, there is a second company, sometimes third or fourth. So there are additional companies without any proper operations. So they have only one job to collect these cash revenues. Because they are doing this based upon that they are billing for using Google knowledge, know-how, intellectual property, something. So practically, this is like a royalty fee. Just this is not a franchise. This is intercompany relationship to utilize the knowledge, and that's why they can create these artificial expenditures and then create these funds. And after that, these funds can be enormous. So because they are just collecting excess, this is not a dividend because that was collected based on expenditure, so before taxation. That's why it has taxation relevance. And after that, they are not doing anything with this. So it's not transferred back home, because in this case, we would be able to see this through the balance of payments. And at the end of the day, if it would reach the United States, then sooner or later taxes would increase there. The big flow of the pre-Trump global world economy is that in many cases, money is just stuck in these low tax havens. And in practice, from short-term funding point of view, that was really easy and really simple to operate this way, because if you need any money, if you would like to open a new data center in the European market, if you would like to purchase any startup which has some promising IP or something, so if you would like to use it for acquisitions, if you would like to use it for new investments, then you don't have to use the parent company's money, because there is this enormous cash buffer. And as a result, they already have the money on site. But until this point, until you don't need this for corporate purposes, still you have to invest this. So many cases or examples when we are thinking that why it's good for Ireland to say that, okay, they don't want to tax these specialized funds, because they are saying that, okay, this money was not realized at the territory of Ireland, so this is not our job. This money should be taxed in the countries where this money was earned and made, because that would against double taxation. That would mean double taxation, so there are treaties to avoid this, except between Hungary and the United States for the last several years now, because of our wisdom and good politicians. So even the commies were able to negotiate a treaty against double taxation between Hungary. So we had a treaty against double taxation since the late 70s with the US, but the current government was messing this thing up now 4 years ago. I know that there are already years when if you are realizing any revenues in the US market, then you have to pay the taxes there, and after that you have to pay also taxes here as well. Yes. which is really strange because if you are going to India, you can work and tax there, and after that you don't have to pay a second tax here in Hungary. So we have it everywhere. Usually countries are doing it. It's a much more like a punitive measurement. And mm, so it's not just about double taxation or avoidance of double taxation, but also this is really useful to keep such funds within your economy because they need investments. They need investment targets, and obviously they need liquid investments. They would like to build up liquid investment portfolios, so they start to purchase government bonds. So this is it's not like a piggy bank. So usually countries prefer to have pension funds because pension funds can buy as much government bonds as possible. Because if the government is not killing them, but if they are allowed to grow for decades, they are just buying government bonds for decades until they are mature enough, and then they start to pay them out. But until then, they are just sitting on a portfolio of government bonds. So this is a really simple way for public debt funding. Also, the same thing is valid for insurance companies, who are usually also forced to purchase government bonds, especially if the corporate bond market is narrow, then they have no other choice. Or this week at Green Finance, I would like to talk about catastrophe bonds, not just green bonds. So this can be also a specialized field of interest for insurance companies and pension funds. But the third major investor, and also banks, obviously. So the fourth major investor can be this corporate piggy banks. There are no special terms like this financial vehicle, specialized financial vehicle, specialized purpose vehicle. So this is usually the terms what is used for them. And for example, in Ireland, even the GDP was increased in 2015 when Apple moved one of their funds to Ireland, and suddenly the Irish GDP was increasing by 5%, and everybody was happy until they realized that, oh, nothing happened with the Irish economy itself, just some numbers were changing on some bank accounts. So this is really interesting. Unfortunately, that one is a highly black box part of the world economy as well, because people know about this, that this exists, but there are no publications about it, or really hard to get any kind of actual data to make publications about it. So that's why people prefer much more bond markets, because at least on bond markets, since it's a market, you can see positions. But if it's a private thing, then it's really hard to do anything. International cash management, that one is boring. So how to collect funds in